So Larry, today you've got a move with another bid coming into the 10-year Treasury. We've got now about, 5 trading days away from the Fed. I was joking earlier, like, I'm just going to go comatose until next Wednesday, man.
I think the market is as well. I mean, I think the market's well entrenched, especially on the back of the CPI number we had yesterday. But wow, what a quirky day today. I mean, we had a coupon supply auction of $78 billion, a stock market rally, a supply-driven spike in oil, easiest financial conditions in a month. And what happens? We see a rally. And also the 210 curve steepening. That's not supposed to happen. So it's pretty interesting. Quirky is probably a better word than interesting, albeit the steepening is profoundly confusing right now.
Tell me about that, right? Because we're getting the bid into the 10, so if we're steepening, that means we're getting an even stronger bid into the 2.
Yeah, so today the 2s dropped about 4.5 basis points, the 10s dropped 3, so we have a bull steepening in effect. And with the market the way it is today, with the results of the stock market and also easiest financial conditions, you'd think the opposite would occur, not a steepening per se. However, to be honest about it all, import-export prices, not a top-tier number by any stretch of the imagination. However, they did kind of pile on the whole narrative of lowflation from the CPI number yesterday. So the thesis of bull steepening and lowflation and lack of consumption is still reigning the day.
All right. Now, we saw some data this morning. Larry's mentioned there wasn't, any big surprises. But let's talk about the auction for a sec, because we did have that kind of scary 10-year auction, recently, where people said, oh, the international buyer stepped away, China's playing games, all this stuff. Today seemed pretty smooth by the measurements that I see, right?
Yeah, it was very smooth. I mean, it auctioned off at the high of the day. Bid to cover was good. Non-dealer bidding was actually really good, something we haven't seen in a while. 30-year traders scratching their head. But like the excuse I think everybody is giving is that when you look at yields, especially the JGB, which yields have dropped 65 basis points since October high, it's all relative at this point. And so the 30-year is still like the place to buy, meaning the U.S. the place to buy relative to anywhere else in the world.
All right, now as this gets back to our big conversation over the past several weeks, several months, Larry, we're getting closer to this event. You tweeted something earlier I thought was pretty interesting at me about maybe even with these rates pushed up. 6 months ago, it was December. Now it's July. But what are you thinking about in the terms of whether or not the market is pricing in next week's event accurately? I mean, should we be talking June?
Yeah, I mean, I think, personally, I think the market's underpricing or underappreciating the fact that it could very well happen in June. Kind of an outlier, but I think people are looking back to the 1990s as their guide, where there was 2 rate cuts in the 1990s. Both had 25 basis point increments, total of 75 bips. Right now, yeah, we're pricing in 68 basis points to the end of the year, but not much, less than 20% of a chance in June. I think that's wrong.
Yeah. Okay. So on the one hand, Larry, I can get kind of the argument, which is, look, if we're pushing up these rate cuts to 70 to 80% in July, well, then why not get a higher rate for next week too, right? I mean, heck, if we're going to go for it, why not go for the gold? But at the same time, doesn't the Fed need to at least get some kind of just test the water first before they jump in?
Yes, and I think that's what the market is saying. The market's not always right. The market's not always wrong. I mean, at least consensus. That said, a June cut is definitely not my base case. It's not how I'm trading per se. But, overall, I do think we're underestimating the fact that might be the best shotgun all around, is like to have one cut and wait, as opposed to unveiling lower dot plot through 2020, addressing all those issues, but doing one big cut, maybe even a 50 basis point cut, and just letting it go.
Yeah. All right. So lastly, is there any more information that we've garnered from this market over the past couple days or this week so far, Larry, to consider what might happen if and when the Fed does cut? Do we think bonds still rally, or has this all been just a concentrated effort and we're going to sell off?
Yeah, I think we still have a pretty good chance of the curve steepening, the 210. Recall that I reversed my whole trading philosophy on that back in April and really got hurt on that. But I do think steepening is the name of the game, which means I think the front end by the end of the year will be much lower than the 10s and the 30s.
Right.
So I would trade it that way as opposed to outright yields.